The psychology of money. Understanding behavioral finance. In the ever-evolving landscape of today's intricate financial world, the ability to comprehend the complexities of decision-making is more crucial than ever. This article embarks on a comprehensive exploration of behavioral finance, delving into the profound ways psychological factors mold our monetary choices. As we navigate through the realms of emotions, cognitive biases, and individual differences, we will uncover the profound impact these elements have on investment decisions. Understanding the nuances of behavioral finance is not merely an academic pursuit. It is a practical necessity for investors aiming to make informed and resilient choices in the face of market uncertainties. Importance of understanding behavioral finance. In the dynamic and often unpredictable financial markets, investors grapple with the challenge of making decisions amid emotional peaks and troughs. Recognizing the profound impact of behavioral finance on investment choices becomes paramount in navigating these emotional waves. This understanding provides a valuable framework for investors to analyze, interpret, and respond to market dynamics in a more informed and rational manner. Impact on investment decisions. The world of stocks and bonds is not a realm solely governed by economic indicators and market trends. Emotions, those intangible and sometimes unpredictable elements, play a significant role in shaping investment decisions. The sway of fear during market downturns or the overzealous optimism in bull markets can profoundly influence an investor's strategies. By dissecting the emotional dimensions of financial decision-making, this article aims to unravel the intricate interplay between sentiments and investment outcomes. Emotional influences on financial choices. Behavioral finance serves as a beacon, illuminating the emotional rollercoaster that is inherent in financial decision-making. It probes into the depths of human psychology, exploring how emotions such as fear, greed, and regret can significantly tilt the scales in favor of one investment choice over another. Through real-world examples and psychological frameworks, we will dissect the emotional underpinnings of financial decisions, seeking to understand not just what choices are made, but why they are made. Foundations of behavioral finance. To fully grasp the implications of behavioral finance, one must delve into its foundational theories, two of the most pivotal being prospect theory and loss aversion. Prospect theory. At the heart of behavioral finance lies prospect theory, a paradigm that elucidates how individuals evaluate potential outcomes and make decisions based on perceived gains and losses. By scrutinizing the psychological processes that underlie decision-making, we unravel the intricacies of risk perception and choice preferences. Loss aversion. Loss aversion, another cornerstone of behavioral finance, posits that people fear losses more than they value equivalent gains. This psychological bias casts a long shadow on financial decisions, impacting everything from investment strategies to risk tolerance. By dissecting loss aversion, we gain valuable insights into the mechanisms driving conservative or aggressive financial choices. Cognitive biases in financial decision-making. Behavioral finance doesn't merely stop at overarching theories. It extends its purview to the identification and examination of various cognitive biases that infiltrate financial decisions. Three prominent biases that warrant exploration are confirmation bias, overconfidence bias, and anchoring bias. Confirmation bias. Confirmation bias involves the tendency to give preference to information that aligns with pre-existing beliefs. This cognitive shortcut can lead to skewed decision-making as individuals selectively process information, reinforcing their existing viewpoints. Overconfidence bias. Overconfidence bias can be a double-edged sword, causing individuals to overestimate their ability to predict financial markets. This overestimation, in turn, can lead to excessive risk-taking, with potentially detrimental consequences for investment portfolios. Anchoring bias. Anchoring bias occurs when individuals rely too heavily on the first piece of information encountered. This cognitive tendency influences subsequent decisions, often tethering them to an initial reference point. Understanding anchoring bias is crucial for unraveling how seemingly unrelated information can significantly impact financial choices. The role of emotions in financial behavior. Emotions, the undercurrents of human experience, play a pivotal role in shaping financial behavior. Fear and greed, the eternal dance that characterizes financial markets, along with regret aversion, which explores the fear of making the wrong decision, create a tapestry of emotions that influence investment choices. Fear and greed. The ebb and flow between fear and greed are integral to understanding financial markets. These primal emotions can drive market trends and significantly influence individual investment choices. By dissecting how fear and greed operate in the financial landscape, we gain insights into the cyclical nature of market sentiments. Regret aversion. Regret aversion explores the psychological fear of making the wrong decision. Investors, in a bid to avoid the pain of regret, may opt for safer options, impacting their risk appetite and overall investment strategy. Unraveling regret aversion provides a nuanced understanding of how emotional considerations can steer financial decisions. Psychological factors in risk-taking. Risk-taking is an inherent aspect of financial decisions, and behavioral finance provides a lens through which we can examine the psychological factors influencing risk perception. This section explores risk perception, herding behavior, and mental accounting. Risk perception. Behavioral finance sheds light on how individuals perceive and respond to risk. The interplay of emotions, cognitive biases, and individual differences shapes the lens through which risk is viewed, impacting the strategies employed to mitigate or embrace it. Herding behavior. Herding behavior, a phenomenon where individuals follow the crowd in investment decisions, can lead to market bubbles and crashes. Understanding the psychology behind herd mentality is crucial for unraveling the dynamics of market trends and the potential risks associated with collective decision-making. Mental accounting. Mental accounting explores how individuals categorize and treat money differently based on its source. This psychological phenomenon influences financial decisions, from budgeting to investment choices, offering insights into the sometimes irrational ways money is perceived and managed. The impact of personality on financial choices. Individual differences, including personality traits, exert a profound influence on financial decision-making. This section explores the role of risk tolerance and decision-making styles, shedding light on how personal attributes shape financial choices. Risk tolerance. Understanding one's risk tolerance is a cornerstone of effective financial decision-making. This individual characteristic influences the level of risk an investor is willing to take on, aligning investment choices with personal comfort levels and long-term financial goals. Decision-making styles. Different decision-making styles, whether analytical, intuitive, or a blend of both, can impact the approach individuals take in managing their finances. By understanding how personal preferences and cognitive tendencies shape decision-making styles, investors can tailor strategies that align with their natural inclinations. Gender differences in behavioral finance. Behavioral finance unveils intriguing variations in financial behavior based on gender. This section explores how women and men may approach investing differently, with women often exhibiting a more cautious approach and men showcasing a higher propensity for risk-taking. Women and investing. Studies suggest that women may approach investing with a focus on long-term goals and risk mitigation. Understanding the nuances of women's investment behavior provides valuable insights into the diversification of investment strategies and the importance of long-term financial planning. Men and risk-taking. Conversely, men may exhibit a higher propensity for risk-taking, influencing their investment choices. By delving into the gender-specific dynamics of risk tolerance and decision-making, this section aims to uncover the factors contributing to gender-based variations in financial behavior. How to overcome behavioral biases. Acknowledging the existence of behavioral biases is the first crucial step towards mitigating their impact on financial decisions. This section explores practical strategies, including education and awareness, setting clear financial goals, and seeking professional financial advice. Education and awareness. Education and awareness campaigns play a pivotal role in empowering individuals to recognize and counteract cognitive biases. By fostering financial literacy and mindfulness, individuals can develop a more informed and rational approach to decision-making. Setting clear financial goals. Establishing clear financial goals provides a roadmap for individuals, helping them make decisions aligned with their objectives. This proactive approach not only guides investment strategies but also serves as a buffer against impulsive and emotionally driven choices. Conclusion. In conclusion, behavioral finance serves as a powerful lens through which we can unravel the intricacies of financial decision-making. From the emotional influences that sway investment choices to the cognitive biases that shape risk perception, Understanding the human elements in finance is imperative for navigating the complexities of the modern economic landscape. As we peer into the future, the integration of behavioral finance principles into financial planning emerges as a transformative force, promising more resilient and adaptive strategies. By acknowledging, analyzing, and learning from the multifaceted aspects of behavioral finance, investors can aspire to make decisions that are not only informed by data and analysis but are also attuned to the nuanced realities of human behavior in the financial realm. Thanks for watching this video. Kindly like and subscribe to this channel and don't forget to turn the notification button